Right, hello, and welcome back to Camel Finance. I'm your boy Camel, and if you're not already subscribed, go ahead and do that. Follow us on Twitter. And today, I want to talk about a recession / the yield curve inversion. So, you may have seen in the news recently that the yield curve has inverted, and this usually sparks recession fears. So I thought I'd do a little dive into this and see if we can't shed some light on it. So first of all, what is it? When the government needs money, one way it can raise money is to issue bonds, and it can do this from short-term bonds such as the range anywhere between 1 and 12 months. It could also do this for longer term or mid-term, 10 to 2 years, and it can do this for as long as 30 years as well. So bonds come in a range of different lengths. The longer the bond length or the maturity, then the higher the yield or the interest that's paid on that bond should be. So that only makes sense if you think about it. If you're lending the government money and they're issuing you a bond, an IOU, then it only makes sense that you would get less yield for a shorter time frame than you would for a longer time frame. So you might expect in the neighborhood of 0.1 to 0.2% for a 1 month bond, and you might expect in the neighborhood of 2 to 3% for a 30-year bond. If you don't know what a bond is, I've got a quick summary clip which I will play you now just to make sure that we're all on the same page about what a bond is.
Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are used to borrow money. For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon rate, to bondholders. The bond market also tends to move inversely with interest rates. So bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall. In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
This is what a normal yield curve should look like, which is perfectly logical if you think about it. The longer you hold the bond, from months to 30 years, then the more interest you will get compensated for that. So this is what a healthy yield curve should look like. What we've got at the moment is a slightly misshapen yield curve in the fact that the longer term bonds are paying less interest than the medium term bonds. As you know, the Fed is currently in the middle of a rate hiking cycle. As the rates go up, bond prices go down. So what this tells us is investors are happier to lock in long-term bonds rather than shorter ones, and they think this is because the rates will be better. As they buy the bonds, the bond price is driven up, and as the price comes up, the yield comes down. Said another way, the market knows that the economy is going to suffer in the short term as the Fed continues to raise rates. When a yield curve inversion shows up and you get say for example the 10-year interest rate drop below that of the 2-year interest rate, people often panic thinking, oh, this is a sign of a recession. And then you get the other extreme where people don't panic at all. They think, oh, it's meaningless. Well, neither one of those are actually true. There's no reason to panic in the immediate term. But one thing that is cause for concern is whenever one of these yield curve inversions shows up, in the vast majority of incidences, these do actually precede a recession by about 12 to 18 months. So it would be absolutely reasonable to expect that we do get a recession in the next 12 to 18 months. A simple way of thinking about this problem is, shouldn't you get paid more for locking up your money over 30 years than for 3 years, for example? Well, of course you should, because of opportunity cost and the risk over a longer time period. It's worth noting, something else about this is, this is a huge fail across the board here. If you think about what is inflation currently, if we take the USA numbers, for example, so they reckon 7.9%. Meanwhile, the 30-year bond is paying, what, 2.4, 2.6%? And What about in the UK? Well, in the UK, they reckon if you take their numbers for gospel, 6.1%, okay? And the 30-year bond paying less than 3%. So if you just assume that they're paying 3% in the UK for their bond, and inflation is at 6.1, you take their number of 6.1, you're losing 3.1% a year guaranteed. Guaranteed. And anyone that has been to the shops, anyone that has been to buy petrol, and so on and so forth, it's pretty obvious that this 6.1 number is not even close to reality. You could double it, and I think that would be far more in the realm of reality, and it's probably higher than double. We're probably closer to triple coming out at the end of this year. And you can see that when places like Audi are posting that they're going to have to increase by an average of 20 to 50% their prices of their food, right? You only have to go to the petrol station or your local supermarket to realise that these numbers of 6.1 or 7.9 are absolute fallacy. So this is an absolutely enormous failure across the board here. And it's also worth noting that banks suffer if the yield curve inverts. When the yield curve is backwards, if you think about it, they're paying interest out to their customers, their clients, so on and so forth. And if the bond yields, where they've got a lot of their money invested, if these are below what they've got to pay out to interest rates, then the banks are going to blow up as well. So this isn't something to be ignored, but it's also not something to panic about immediately, as I've already said. With all that said, where are we now? Well, currently we're at a 10-2 inversion, and we're also at a 3.30 inversion in the US, I believe. And this usually precedes a recession by 12 to 18 months. So what will happen, likely, is we will move out of this year, and we'll do okay going out of this year. And then this will all start to catch up. And it's worth noting that before we had this plunge in the 2020 for the pandemic, a yield curve inversion showed up around 12 to 18 months before that as well. And whilst no one could have predicted that event, it is quite interesting that one of these yield curve inversions shows up, and then within the specified time frame we do get an enormous plunge. So going forward, the Fed is going to keep raising rates in the short term, but it will have to stop raising rates, and likely sooner rather than later. And then once it's stopped raising rates and we've had some big sell-off in the stock market, the only way to fix this problem is going to be more printing, more quantitative easing, and more propping back up, which is in turn going to lead to more inflation. And therefore stocks, precious metals, gold, silver, etc., and Bitcoin are all going to go to new highs. So with a longer term view, this isn't really a problem and does present an opportunity to buy the dip, but for sure you would want to be proceeding with caution at this point. And of course the harsh truth is anyone that doesn't own hard assets in a time of high inflation is certainly going to suffer. Is certainly going to be going to the shop and noticing this more and more, noticing their energy prices increase, noticing fuel prices increase, clothes, everything is going to go up. Well, everything is going to appear to go up, but it's not actually going to be going up. The currency, the fiat currencies that are being printed into oblivion, that are being inflated into oblivion, are going to go down. If you've watched this channel for a bit, you will have known that the message here is the mainstream news is often not to be trusted. They'll tell you not to worry. Here's an example of that. Don't fear the yield curve. Of course, this is nonsense. This absolutely does have implications and will almost certainly lead to a large market sell-off in a 12 to 18 month time frame. But with a slightly longer term view, we do believe that there will be enormous opportunity coming up, and we will certainly hope to be capitalizing on that opportunity. I hope you liked today's video. I hope it wasn't too wordy. I hope I sort of made my point clear enough. Please let me know if I didn't. Please let me know if you have any questions. I'm your boy Camel. We do this every day, and we'll be back tomorrow with more of the same. Until then, take care. All the best. Bye.